Hey everyone, what we're going to do today is a macro picture. We're going to take a look at the indexes, we're going to take a look at the economy and what's going on under the hood. We're going to look at the top 10 most active stocks by all hedge funds and look at their fundamental analysis, drill into them and really see why people are interested in them or why they are throwing them by the wayside. More importantly, going forward, this is going to be the first attempt at this podcast. We're going to have different guests on. I want to start having analysts on. It's becoming increasingly clear to me that even though I am a technical trader, I am constantly looking at macro data that is giving me some idea of a thesis. I don't act on the thesis all the time, but it's very important to have an understanding of that. So bear with me as we begin this. But I really think it's important to drill down into these numbers and for people to understand. For the people that are going to be listening to this on audio, bear with me as I have to get used to not saying this and that. I will have some slides that you can click, link in description if you're seeing this on YouTube. I'm going to put this on the current YouTube channel, but this will also have its own channel as we start doing more interviews. And if this goes over well and people like it, comment on it. Comment how it could be better. You're not going to hurt my feelings at all. And those comments will help me create content. But let's just get right into it. So what I have up here right now on the screen is I just have asset class benchmarks. And what we're going to look at is we're going to look at these benchmarks and how they did. Now, Friday was the close and it was quad witching. When you see this, you can see 916 over here. And I think it's going to be important to start with something that just happened. As we go forward with this, I think we'll do it weekly. I think that would be most prudent. But you can see that the emerging markets was the worst performing out of everything. Total return was next, which was the Russell 2000, the small caps, which really has been hanging in there until that now. Then we also saw the MSCI ACWI total return ex-US. So let's drill into a couple of these so you can see what they are before we go a little further into the S&P. Okay, so this is emerging markets. So you can see over here that the emerging markets captures large, mid-cap represents 25 emerging market countries. So essentially what they're doing is getting out of emerging markets. So that would be Brazil. We're going to drill down a little bit into these numbers today. And we're going to take a look at where the inflows are going into ETFs and where the inflows are coming out of ETFs. And that can tell you where the big money is positioning themselves and how they are positioning themselves, which is very advantageous to us, right? So in other words, I'll tell you how this could be actionable. Let's say that you were interested in buying a Brazilian oil company. All of a sudden, when you see what we're about to go over, you might not be so interested. Let's just start jumping into a little bit more of this. So the MSCI ACWI ex-US covers the major development emerging markets and countries, however, does not include the United States stock market. This is an important benchmark for investors analyzing how the markets outside the United States are doing. So there is a current theme going on here. And that theme is, on Friday, we were getting out of emerging markets and anything that was not in the US. Interestingly enough, even commodities underperformed the S&P, which is rare, and we'll get to that in a moment. But you saw money even flow out of the bond market. Municipal bonds were down. So there was really no safe haven on Friday, despite the fact that we did bounce off the lows. And I think the takeaway from this is that if we just focus on what happened on Friday on quad witching, there was not a flight into emerging markets. There was not a flight into Asia. There was just a flight of getting out of everything. And more importantly, that flight was exacerbated in emerging markets and in areas that were not the United States, also in small caps. Now that you have that daily data, you have to think, how could that possibly be useful? Well, you can go and take a look at what's happened over the past month. Now here you see the S&P and the total return off its percent of the high. You can see you're down 9% for the month. And during the same period in time, if we review the ex-US MSCI, right, you can see where we're at okay, and how that has been actually outperforming the S&P. Well, that wasn't the case on Friday. So that is something that you might want to pay attention to. Did inflows and outflows change? Is money that was ex-US going into the S&P? It's something for us to look at. Now, we also can see that emerging markets across the percentage are only down 6.8. And they also underperformed on Friday on the US. So when we see things like that, we just kind of want to pay attention to it. If you take a look at the year to date of these numbers, you can see that the S&P is down 18.32%, where the MSCI ex-US is obviously down more, and the emerging markets is down more, 23.48%. But what's important about that is it's possible that that is starting to accelerate again. It may have outperformed for about a month there, and now we're starting to see this roll back over, which makes a lot of sense. Flight to safety, you usually go towards the biggest game in town. Now, while we saw outflows and selling in the Russell, that is a little different than what we see happening in equity funds. So we see money going into U.S. small cap value ETFs. These funds right here are growing. You're seeing the U.S. small cap cash cow fund grow, Capital Group, Global Growth Equities. You're seeing inflows where? You're seeing inflows into U.S. names. That is where the equity funds are gaining assets right now. So when we see this, that may make us lean one way when we're making some decisions on investment. It might state that, hey, we want to see why people are putting money in there. There's a lot of different little names in here, but you'll see a very common theme where you'll see the name small cap repeatedly over and over again. Very rarely are you seeing the name emerging markets in this group. So when you start to see those kinds of themes, you want to look at them. You might want to start looking possibly at small cap names. So hopefully you can find and see how this type of data could be helpful. If you start taking a look at equity funds losing assets, you're going to see ARK obviously in there that's been bleeding. But take a look at the MSCI, all country Asia ex Japan. You're starting to see money outflow out of Asia. Okay, you're seeing money flow out of Europe. Okay, you're seeing money flow out of U.S. mid cap. So when you start seeing this money flowing out of Japanese hedged equity, coming out of Australia, coming out of Taiwan, coming out of the United Kingdom, coming out of Brazil, when you start to see this happening with these ETFs, EWZ, EWU, EWT, EWA, probably not the best time to be investing in any company that does a tremendous amount of revenue out of those areas, because there's only one reason why this would be happening, and that's because they're expecting a slowdown in those areas, and they're possibly expecting it to rise in other areas, such as small cap value or cash cows. In very trying times, what you'll see happen is you'll see people buy dividend stocks, buy Johnson & Johnson, as someone in our trading community mentioned today. You'll see those kinds of names get bought because people want dividend and consistent yield, and they don't want to deal with what they're dealing with. Side note, the last time that the market sold off drastically, you will notice that in 2008 and even in 2000, IWM, which is the Russell, it is the first to rally because it is the easiest ship to turn, because smaller capitalization names turn a little bit easier because they can adapt quicker than larger companies. If you think of it like a ship, it makes a little more sense. So if you take a look at the asset classes, just to get a sense of where we are in risk versus reward. S&P 500, if you take a look right here at these axes, this is going to give you your standard deviation over 5 years. Over 5 years, the S&P standard deviation has been 18.4%. You can see from your zero line going straight across there, and I apologize for those that are just listening on audio, but I will get used to it. You can see from this level right here that the S&P is below the zero line, well below its 5-year standard deviation of 18.4% and negative 12%. Looking directly at the graph, you only really see one area that is clearly above its 1-year return. There's only one area that is shining right now, and that is the Bloomberg Commodity Index total return. So if you were to look at who's outperforming its 5-year standard deviation right now, it's a very clear indication on where money is going. The commodity index, if you look at the 5-year standard deviation, you're at 16.72 versus 1950, where you're at right now. Now, that's energy. Okay? Obviously, there's other commodities that are in there as well, but that might mean, hey, maybe we should be looking at fertilizers. Maybe we should still be looking at oil. Everyone has an opinion on oil, from it going to 80 to 120. What I'm trying to do with this particular piece of content that I'm going to be putting out is not to give you that many opinions, even though I'm sure I'm going to have them, but to get you to think a little differently and start learning how you could utilize this information. I will tell you, no one predicted the pandemic. You're going to find one person that talked about it somewhere, and they're going to keep talking about that, right? But no one truly predicted the magnitude of that move. No one predicted that oil will go negative the same year. So no one predicted that oil would go up, so the way that it has with the Russian-Ukraine conflict. So instead of just trying to predict, I think it's better for us to analyze what's going on. And if we wanted to see who's really outperforming their 5-year standard deviation right now, which is a pretty good metric to use on where the money is going, you can see very clearly that is the Bloomberg Commodity Index, and that overall the Russell, S&P 500, they are very significantly below where they're supposed to be. So we're still possibly seeing that weakness there. And until we start seeing that weakness in the commodity index, that might be something that we may want to look at. We may want to look at those kinds of companies going forward. Now, if you take a look at fixed income, this will give you an understanding of where they're currently putting assets. And this is very important. It's important because it tells you the thought process on the current investor. So in other words, are they going out long-term or are they going out short-term? Are they buying high income or are they buying high yield? Or are they buying governments only? It's very helpful to understand this data because it tells you where their head is. They might want to be more short-term right now, which is obviously the case. And we'll get into that. But you're seeing the top fund's really a high income fund, which is going to be a high yield fund. You're seeing municipal bond money pour in over and over again. And the total bond ETF from Vanguard is obviously seeing some inflows here. But what I'm taking away from this, if I was to look at a theme, I'm seeing very short term throughout here. You'll see this kind of level, government fixed income, short duration, fixed ETF. You'll see this over and over again in municipalities. So what we're seeing is, let's put our money short term, let's put it in municipals so we know that it's safe and we don't have to worry, and let's see what happens going forward. This is very telling. It's more telling than I'm making it out to be right now, quite frankly. If you're seeing people put money short term, we know that the 10-year bond is at roughly 345 going into this current Fed meeting. We know that the 2-year is around 380 right now. So that disparity and flip is a clear sign that we may be going into a recession, especially if you're paying more on the front end than you're paying on the back end. You have an inverted yield curve, which tells you that a lot of people are expecting the Fed to overshoot. We'll see what happens this week on that. Now, if you just kind of take a look at long-term flow trends and you take a look at the U.S. mutual bond flows that are going on, this is extremely telling. So you're just having dumping after dumping. So U.S. bond mutual funds, year-over-year change from 1 year is down 71%. Bond ETF net issues down 70%. ETF U.S. net issues down 56%. Okay. Equity ETF net issues, 48.8%. When you start seeing things like this, it's just absolutely glaring. Money is just literally pouring out. They are not creating new bond ETFs. They are not creating new equity ETFs. Until this settles down, I think that you're going to see that theme continue. The target for the federal funds rate right now is at 2.25%, and you can see the 1 year coming from January on. So just to understand the magnitude of this kind of move, in January, March, in these areas back here, you were roughly at 25 basis points. You're now at 225. Everyone is watching this extremely closely. I would tell you if you go out a little further and you go out 3 years, you can see the pandemic and how essentially it just went to zero. So we have free money. Free money flows into the economy. People are buying everything they can get their hands on. Everything is trading up, and now comes that price tag. Now, if you take a look at this over a 5-year period, you can see that before this, you were right around that 225 level as well. If you take a look at something along the lines of 10, you'll see that the move before that from 16 to 18 on is when you had your spike. The pandemic brought you back. So you're really just getting back to where you were before on that target Fed funds rate. If you take a look at this on a max level, you'll note that you're really nowhere. From 2010 or 8 on, which was the great financial crisis, your Fed funds rate was essentially free money until you got to about 16, then you had to pay something. But previously, your Fed funds rate in 06 was 5.25. If you go all the way back to 2000, it was 6.5. So the comparisons here to something along the lines of this is like 2000 or this is like 2008, it's far from that, from a Fed funds rate. Fed funds rate, if you think about it and you look at the bond market, that's how you borrow money. That's how you get a yield. So from my experience when I was trading back in 2000, we had a much higher 10-year bond. We were competing here for a 10-year bond was paying you 680. You had a high yield coupon out there that you were able to get a bond on that was roughly 10% on your money if you were willing to buy a little high yield. I remember GE back here had 8% bonds, and it was General Electric, which actually meant something back then. Now, if you take a look here in 06, very similar, you have that 5.25%. Well, you were right around there, 5.5, 5.75 on a 10-year. The purpose of understanding this is right now you're at 2.5. And if you take a look at that 2.5 versus where you're at on the 10-year, you're way over that on the 10-year right now, aren't you? Right? So this is roughly 2.25%. If you go and take a look, well, it's 2.25%. I don't know why I said roughly. It's exactly 2.25%. If you go back and look at December and January in 06, 5.25%. Okay? But the 10-year was around 5.8, much closer than it is right now. So then you go and take a look at where you were in October, 6.5%. Well, I said that we were roughly around 6.75, 6.8%, right? So all of a sudden, the 10-year was much closer to Fed funds than we are right now. Well, that's a big disparity, and hopefully you can see how that disparity is going to have to fix itself. Either Fed funds is going to go up much higher than we think it is, in my opinion, or the bond yields are going to have to come in. But there's a disparity there where we really haven't had, when we've had these kinds of moves, where we haven't had this much of a gap between the 10-year and the Fed funds rate. And that's, I'm showing this during the peak and trough times. Trough times is kind of hard to imagine because from 2010 on, you essentially had zero. So that is one data point that you might want to watch. There is a theme there that we are seeing the 2-year rise faster than we are seeing the 10-year rise. Reminder that this is the maiden voyage of doing a macro podcast, so your comments are appreciated below. It'll help me make it better on where you want the focus and how you think this can be useful. The whole purpose of this is for you not to be blindsided, like I saw so many people not understand why CPI was so important this week. And I really think that you having a better understanding of what's going on out there, I think we all can benefit from that. You take housing starts, for example. If we take a look at this year to date, we could say, well, this looks awful. We're just falling off a cliff from 2021 to now. We just keep coming down. Over here, you can see the basic information on what housing starts are. What you want to look at is just, they are the total number of single-family homes that started construction on any given month. Okay, it's a forward-looking metric to gauge the outlook for the economy. The problem with this metric is that it doesn't work as well as people think it does, and I'll explain why. If you look at this over a year, you're down from where you were a year ago. but not a lot. Now you look at where you were 3 years ago, before the pandemic. Okay, you are still above pre-pandemic levels in 2019 on housing starts. So we are not seeing an implosion in housing, despite the fact that we are off the multi-year high of a 3-year high, possibly a 5-year high. Yes, we are off a 5-year high. But if you take a look at where we were even in let's take November 17, you're at 1.27, okay? 1.27 million versus 1.44 right now. That's not exactly this massive decline. Okay, we didn't fall off a cliff like we did during the pandemic, which for obvious reasons was going to happen if you're not building. Now, if you take a look at this over a 10-year period, you can see that you've just gone completely up the whole time with a couple bumps. If you take a look at the max, which I think is very telling, and you just go from 1960 on, and you can see these levels and these bumps and where you were in the 70s and the 80s. Now, just to put it in perspective, looking at 1980 is very similar to where we are in this market. Why is this similar to where we are 1980? CPI is currently the highest it's been over the 10-year bond right now. The last time that we had this level of disparity of CPI over the 10-year bond was 1980. Do you know what the best performing asset class was during that period of time? Commodities, which we just showed previously. Now, the purpose of understanding that is that might give us some understanding on where we could possibly go to with housing starts. I'm not so sure that we see that. I'm not so sure that we don't have a better supply chain system than we did in 1980, though some people may argue that that might have been a little bit better, considering what we're dealing with right now. But if you focus on something like this and you go, okay, well, we came from the peak to down. Well, that's very similar to what's going on right now. But looking at this from max, and you look at this over a 40, 50, 60 year period, you are far from where your peak was. On top of that being near the peak, if you go back and you just look at where you were in '06 during the boom, you're nowhere near that. So if you're nowhere near '06 and you're at those price points and you're over those price points, well, that makes sense that you'd be over those price points on your house. Why? Because we don't have the supply. So we've added more people to the world. We've added more people to the US from '06, right? '05, and we're still producing less houses. So when you think about it from that perspective, and then you look at where you are from the pandemic and go, all right, so we were at 1.57 in housing starts. Now we're at 144 million. Okay, over 2 years, you're basically flat on the number. Now, the number showing no sign of getting better. I agree with that because that's going to be the first argument we're going to hear. We've done nothing but decline. But are we going to see that move where we dropped like in 1980? I'm not so sure. You have substantially more people that are looking for homes right now. You're constantly hearing people going, I can't find anything even though the market's supposed to be coming in. And that's because you just don't have supply. And this is very clearly showing that you do not have supply. So how could you benefit from that? Well, one way to benefit, and we can go and take a look at this, is we can go take a look at home builders. Now, home builders are a very easy group to trade because home builders trade like value names. So understanding that we have short supply, nowhere near what we had 14, 15 years ago, we can go and look at the home builders and we can use valuation metrics to determine which one of those we might want to look at. So what we'll do is we'll do the home builders as well today. As I said, you're going to have to deal with me. This is the maiden voyage of this. Your comments are going to be appreciated on what was helpful and what was dreadfully boring. Audio people, if you can please leave comments when I upload this into a podcast form somewhere in the interwebs, that would be very helpful because I do know that I say this and that a lot, as Emily tells me. So let's keep going. Now we understand that the home builders may not have the problem that they thought they might have or the problem that we think they might have. Obviously, those stocks have come down and we'll review their metrics in a little bit here, but I think we'd be remiss to not go over the 30-year mortgage rate and what's going on there. Now, can mortgage rates go up and the housing market stay where it is or level off? And the answer is yes, it can. People need a place to live. Are they going to pay more money? Possibly. They might buy less house. Instead of buying that $700,000 McMansion, they might buy that $350,000 townhome. So the housing market will change based upon the price point. That does not mean that people are not going to buy something. They might just buy something less expensive and wait. But it does greatly affect the mortgage industry. Now, why will it affect the mortgage industry? Because those mortgages are going to be less. Whether someone is selling $300,000 townhomes or selling a $900,000 home, if they know what they're doing, their gross margins might be roughly the same. They won't be that far off. But the person that's going to go out there for that 30-year mortgage, well, all of a sudden you're not getting that huge mortgage anymore, right? You're going to want your payment substantially less. I mean, if you just think about it from here, if you started in January, you were at 3%, 3.25%. You're at 6% right now. If you take a look at this over a year period, you can just see from October on 2.8 to 6. So you're almost at a triple 3-year period. You can see how you leveled off since the pandemic. 3.6 came all the way down, and you're now a double. And it's important to kind of walk through all of this with the 5-year and how you're sloping down and you're at a 5-year high. Look at this over a 10-year period, and you can see you're at a 10-year high. Why is this important? Because when you max it out, this will be very glaring. Okay, when you were in 2007, 2008, in that period, you were roughly at a 6%, 6.7% mortgage rate. Well, this is nowhere near those kinds of levels where we're going to drop off. If you remember the conversation we had a little earlier about where we are with home sales and housing starts and how they're dropping, and we talked about 1980 and why it's not going to be as bad, this is one of the reasons. In 1980, your mortgage payment was 17.5%. In October, it peaked at 18.63%. We are nowhere near that. And I'm not suggesting that that's going to happen. Now, if you see a spike up and you start getting into the 7s and the 8s, that's going to become an issue. And we don't know where this is going to stop, right? We have to keep watching CPI and PCE and keep connecting the dots like we're trying to do right now. But I do think that it is possible that certain home builders do well. Maybe the aggregate comes down, but I do think certain home builders can do well in this environment, even though companies that are mortgages may have an issue. One of the ideas I have is an iShare called REM, and it is a mortgage REIT. Essentially, it's a ETF. And it's something that I personally am considering possibly putting a short position on if it rallies. Because if this increases, it's going to be very hard for mortgage companies to flourish, even though it is possible for certain home builders to do well in this kind of environment. If housing starts were near '06 levels, I would have a different opinion. The CPI this week, when it came out, we were looking for a negative 0.1%. To put that in perspective, we were not looking for that all year long. Not one time was that our estimate that we were going to be negative. When we got to the zero line, we bounced. That's the issue that we dealt with, and that's why we had such a huge sell-off. We were expecting it to start going negative month over month. It did not. It actually came up. Now, when you drill into those numbers, you can see that the majority of that was rents, housing, shelter. I will just be pretty blunt about this. If you look at how CPI is calculated, I actually put a newsletter out where I covered it last Wednesday. I'll put a link in the description to get a copy of the free newsletter. But what's interesting about this is shelter, they can only go by the previous lease. They can't go by new leases being signed. So you're always going to be behind on your shelter and rental number for obvious reasons, because they can only use the past, not what you're currently signing today, because they just don't have the data. So it's always lagging, and that's why it's spiked up right now. It doesn't matter the reason. Nonetheless, we sold off, and it is what it is. But I do think you need to put it into perspective when you really see what's going on out there. You've had these peaks, huge peaks in March, 1.24%, month over month, 1.32% in June, and now you've just absolutely are starting to collapse down. So when you're starting to see the CPI collapse down like this, it's very hard to say that this is not going to get better. Now, you need this to start getting negative. You need to start seeing this slow down drastically, because if it doesn't, then it's just going to put us in a position where this is going to drag on and inflation is going to stay high even longer. By going negative on the month over month numbers, what we're really focused on is that can we get negative? Can we get that month over month negative, right? You want to be super technical. We had one in July that was 0.02, being super technical on the metric, but I think that's what we were really hoping for. And when it came in a little bit higher, everybody just panicked. And one thing I will say about the market is it's starting to be a little bit on a hair timed trigger. And I think that's kind of interesting. Usually that kind of volatility leads to a massive move, but we'll address that in the daily videos that we do on the Arete trading. U.S. corporate profits are up, and I think that this graph really states that very clearly. So I'm going all the way back max on this, and we can go back 10 years and take a look at it as well. But I just think this is absolutely glaring when you go back and you look at where the first data was calculated back starting in the 40s, and you start going through this and realize that U.S. corporate profits after tax is at the highest level it's ever been while we're going through this. I can't remember a time when we've had the percent so high and we're going through a period where we're just absolutely collapsing. If you look at the 5-year, I think it's the long-term average is 7%. But if you take a look at where you were during the pandemic, you were at 8%. So when you start seeing these little dips that are happening, you kind of have to take note, like where were we in '01 when we imploded? Well, corporate profits were at 5%. You take a look at '08, where were corporate profits? Okay, they were 8.6%. Corporate profits are at 12% at all-time highs. And what do corporate profits lead to? Earnings per share. It's very hard for the market to continue to drop unless corporate profits start coming in. Now, we are seeing some blowups. We are seeing signs that this corporate profits may come in. We did see FedEx blow up this week. If we continue to see things like that happen, where FedEx has a bad quarter, a very bad quarter, where they don't even want to go out and state what they think is going to happen going out to fiscal 2023, and these companies start losing 20% of their value, I think that you are going to have a problem there, and they are going to do some earnings revisions. And if they do earnings revisions, yes, corporate profits will come in, earnings will drop, and then the S&P could contract even more on the price earnings multiple. But as we're going to go through some of the top 10 companies that hedge funds own right now, and we're going to go through their corporate profits, look at their price to sales ratios, things like that. And that will give us an understanding of what's really going under the hood and why they're buying certain companies. Now, U.S. existing home sales are currently 4.8 million. If you go back and look from January and you start where you were at the year, you were roughly at 6 and a quarter. Let's go exact, 6.09. Now you go out and you take a look at a year and go, okay, where were we 12 months ago? Well, we were much higher. We were still around that. Now we were at like 6.18. Okay. So then you go out 3 years and you take a look at it and go, well, pandemic, we were at 4 million. Are we at pandemic levels yet? No. Are we heading that way? You're seeing existing home sales. People are not as interested in buying existing homes as they once were. Why? Because you're watching the mortgage rate, right, rise. So if the mortgage rate basically doubles, housing sales on existing home sales are down about 20% from that number versus the mortgage rate and what the mortgage rate's done over that period of time. It's kind of interesting if you think about it from that perspective. So even with the huge rise, the percentage change in existing home sales is nowhere near what it is. So that's a data point, and that might kind of fit our thesis and what we talked about, where maybe the mortgage industry doesn't do as well, but maybe the existing homes do as well. This did not have a massive drop down. It is having this slower trajectory. The issue with inflation is the higher the higher it is, the longer it's going to stay there. That's just the issue. There's no magic bullet here. There's no, I know that we're talking about 2%. I'm not going to get into my opinion on that, but it takes a long time to come in. As that time takes to come in, people are going to have to figure out where they're going to live and what they're going to do. And that might mean buying an existing home that they need to buy. And I think that that's something that we really need to focus on. You're down 20%. You're not down this hockey stick. You're on a slow decline, and certain housing markets are going to obviously fare better than others. But when you start looking at this over a 5-year period, you're really not that far off of where you were in 2018, 2019. Now, it's not the peak on where we were. It's not the peak from '01, and it's not anywhere near that. If you go and take a look at where you were, I mean, that was obviously the peak in '01. We go take a look at a max chart, and you're going to find '06, right? Because that makes sense, the existing home sale. So you're nowhere near that, and you're nowhere near the trough of where you were in '08, '09. So I think that this is very important for us to understand, just get some perspective on it. Yes, we're not at the same level. Does that mean that we should be shorting the home builders? We'll get to that in a couple minutes when we start running through the home builder stocks and start looking at their fundamentals and getting a real picture there. Now, this is one graph I did find troubling. U.S. personal savings rate is currently at 5.1%. Year to date, it is down precipitously from where you are before. The reason for this is obvious: inflation. As inflation goes up, people are getting more into their savings to go out there to buy gas, to get food. This is something we need to pay attention to because it can obviously affect retail spending. Housing, you're going to need some place to live, whether that is not exactly where you want or not. You're still going to need that roof over your head. You might not need that luxury item. You might not need to go to that store and buy that suit. There's a lot of things that you might put on hold. You might not buy that car. But if you take a look at this and you take a look at second quarter 2020, everybody, was the highest savings rate we had in forever. Despite the stimulus checks and everything else, people weren't doing anything. There was nothing to do. We were on lockdown. So you really can't use these levels of 26% or 16% or 20%. And you can't look at them realistically as something that we need to focus on. If you go back 5 years, this is something that we can focus on. So if we take out these two anomalies that happened in 2020, second quarter, and we take out this one that happened in 2021, where you're at 20%, and you go, let's go back to pre-pandemic levels. And you go, okay, so if the savings rate is 7.2% in third quarter 2019, and now we are where we are at 2022, well, that's a big difference, right? You're roughly 30% off less in the savings rate from there. If you go and take a look at a 10-year and you start looking at that number, well, this really starts becoming concerning because 2013 and back, you were at 6%, 7%, all the way before the pandemic to the end of 2019. So you are below historical 10-year averages, and that is concerning. Now, they're coming out and saying that the actual long-term average is 8.78%, and if you take out and go all the way back to 1947, yes, that's the case, but there was a lot different to view then versus the last 10 years, right? So by looking at this, we could see that, yes, the consumer might be in trouble. And we're already seeing signs of that, where the higher end luxury stores seem to be doing well. It's the lower end stores that seem to be having a problem. The people that are always trying to make ends meet always have the hardest time with inflation. And that's exactly what's going on right now. And we're seeing it. So when we're looking at those kinds of companies and we're looking at retail as an investment, you really want to look at this U.S. personal savings rate. Okay, there's a lot of bargains out there right now and a lot of very interesting patterns for those that have listened to the top 10 video that I did today. You'll see that I even had Amazon in there. I think the chart is very interesting for a low risk entry dependent upon the Fed, and we'll have to see how we open on Monday. But yes, I'm interested because it might be a low risk entry, not because we're going to see this huge boon in consumer spending. I just don't see it. I know retail sales are good, but overall, the savings rate is telling. It's very telling. Now, for some good news, the producer price index year over year is down, and it's been pointing down. This is a good sign because when you look at this in conjunction with CPI to understand how prices are changing in the U.S. economy, a change in PPI often anticipates a change in CPI. This is very true. So if you were looking at the numbers that came out, most people glanced over PPI. PPI came in just fine, and PPI is actually exactly how they're saying right here. It is going to lead. It is going to be the leading indicator for CPI. You have that one component of rent and shelter that is giving us a little bit of a hard time right now, and that might persist. But overall, you're seeing nothing but a drop, and you're seeing that drop after you peaked in March, and then you kind of tried to rally again on it in June up to 11.3%, and you're coming back down. This does take a while to come back down, but as PPI comes down, the ability for people to produce goods and sell to the consumer and pass that savings on to the consumer gets a little easier. We still need to pay attention to that savings rate though. Now, taking that data and trying to figure out what to do with it. What we're going to do is we're going to utilize that to possibly find some opportunity, or at least find areas where there might be opportunity a little bit longer term. Again, when you start looking at macro and fundamental analysis, that kind of gives you the who. It doesn't really give you the when, but there are some really glaring signs. In my experience in trading, one of the most glaring signs that you may really want to look at the home builders. And if you do this, you've done quite well over decades. If you do it when it happens, is you look at whether or not they are under book value. If you are buying a home builder under book value and you really have done your homework on that book value, you will find that it presents itself very, very nicely. Now, what do I mean by that? Meaning that eventually you will see the stock start to do very well. If you take a look here on Toll Brothers right now, you're at 0.89 on the year to date. Take a look at a 1 year. Okay, you can see you're up here. Usually rule of thumb is when they're close to 2, you sell them. When they are near or under 1, you buy them. If you had done that in March, like everything else, you would have done okay. If you take a look on a 5-year, you really have not been on this level or this low for some time. So the idea here is to understand what we have. And we have a data point, right? And this data point is saying that so much is baked into this company that Toll Brothers, one of the largest builders out there, that we're being told that it's going to trade under book value forever. And if you go back and just take a look at this, let's go back from 98 on and just keep taking a look. See if we can find something that even fits where we're at right now. And we're going through 05, 06. Right? So here you go. So now we're under there. And then 07, we broke book value. So during the great financial crisis, it looks like 0.74 was the absolute low there. Now, if you kind of go through this, 7.5, and you look at where you're at right now, you're at 0.89. So does Toll Brothers deserve to be at the same level as the great housing crisis? I would argue no. Does that mean that you're going to go out there and purchase it tomorrow? No, it does not. You're going to have to drill into it. You're going to have to look at a little more data before you could make a decision like that. I only buy based upon technical analysis after the fundamental and the macro is done. But that's definitely something for you to look at. Now, we could go through this with all of them, but over here, I already have a bunch of them mapped out. And you can see DH Horton is at 1.36. So that wouldn't fit in there, but now you have KB Homes. So KB Homes is a very large one that we should always look at, right? But if you know that you're below your book, and you come here and take a look at that, well, that's very interesting. And then you kind of take a look, has it been there before? Well, yes, it has. Okay, so if you drill into these and see, okay, in 16 it got that low, but other times you really never got to that 1. So here you are again at a level where you are trading lower on book value than you were trading during the great financial crisis and housing bust of the market. These are at lower valuations. Now, to put this in perspective, we should look at more data. As I stated, this is the maiden voyage of doing this, so your comments are greatly appreciated. One thing I will say is as we did this, we saw a disparity in the macro data of housing starts and existing home sales versus mortgages. Well, that led us to go into look into some of these names. Now, when looking into these names, we found two of them, Toll Brothers and KBH, that have been around a very long time, that are currently trading under book value. We all know they own land. We all know that land can depreciate if we do go through a very rough time. So we do know that those book values can fluctuate. They're not making any more land. And eventually those prices do come back. So I understand the counterpoint, but also understand that those fluctuations in land really don't matter to places like KBH or Toll, because they'll just sit with it until it comes back. So if you take a look at where you're at here and just look at this 1 year chart, and you can just see your price to sales ratio that you're currently trading at 0.4 times sales. Do you think that they're expecting the end of the world here? If you take a look at a 5-year time horizon, you are really nowhere near your average, right? So you're way off the average for there. Take a look at the past 10 years. And you can see this massive decline. So again, if we take a look at the max, because what you'd want to do, the comparison you'd want to do here is you'd want to look at where you were at during the great financial crisis, right? That would make the most sense. And you got down to about 0.27 there, it looks like. Let's blow this up a little bit and take a look at that. So that got us to about that 0.36 level. Let's take a look here and see if we got a little lower. 0.2 times price to sales, which is just absolutely insane. So you're not really that far off from it here, are you? And we don't have anywhere near this type of crisis that we had previously. Now, if we take a look at Toll Brothers as well, and we go, okay, well, 1 year out. Well, I can understand us coming off that 2020. We're not seeing as many new housing starts. You're trading at 1 time sales there. Now you're currently trading at 0.54. Let's just do the same thing here and take a look. Where were we during the Great Crisis? And you're going to, they're obviously going to trade differently, but you're at 0.66, 0.63 in there. So you're not even at 1 time. Now here you are again, you're at 0.54. So just to put this in perspective, we are trading lower than we were on this name than during the financial crisis, when the housing market completely imploded. So I would argue that maybe we're a little overdone on some of these names for those people that are looking a little longer term. Again, this is going to be more macro. The technicals on those charts, we all know what they look like. But if you go and take a look at the PE ratios and say, geez, what was the PE of this during that period of time? It looks like it was a non-event because there were no earnings. Right now, the PE of this company, and we're trading at a PE of roughly 5. That does not look like a ringing endorsement of something that is going to fall off a cliff, right? Now, if you take a look at profit margins over the 5-year period from 2018 to 9, you're going to see that your profit margins from the pandemic, when you were this low, right here on your price to sales, if you look at your profit margins, they are double. So I have double the profit margins, and I am trading at the same level on the pandemic price to earnings. If I go and take a look at this on the profit margin side, okay, I'm on the profit margin. I'm at 9-10% on profit margin. During the great financial crisis, we obviously had huge write-offs. So something doesn't add up there. So by drilling into those macro numbers, we were actually able to find a couple ideas that might make sense for us to look for on a chart. Right? We might want to look at those technically later, or if we're ultra long-term investors, 3 to 5 years out, that might be a safe place to put some money, right? So that might be something that we want to consider or look at. It's just an opinion. That's all it is. Another way to use macro fundamental data is to go through and look at the top 10 stocks that are the most active right now for hedge funds or institutional investors. That's what we're going to do. We're going to look at this data and we're going to compile it and see if we can see what they're saying in that from a fundamental or an overall picture or macro basis. So if you take something like Tesla and we look at the price to book value, it's still 26, which is absolutely very, very high for any company, but any growth company is going to be like that. But really what we're trying to do is just understand where we are over a 5 or a 10-year period. And you can see since the pandemic, you were roughly at a 9. Now, if you see during the pandemic, obviously you were at astronomical levels. You're still at a very ultra high level being where you're at. So could this still come in because of the price to book? It could, but that's not really how we've been trading. So what we would have to do is drill into this and say, okay, what are people seeing? Why would somebody be interested in this? Now, in looking at this, we're going to be able to see a couple things. I'm going to leave the price to sales max up for a moment here and then move into the other indicators. But if you just look at this, take a look at this. So here you're trading at 30 price to sales, okay, and now you're trading at 14. All right, so you're right in line with your correction on where the stock is if you take a look at the stock price, and you just can see these peaks and you can see how you're holding in here. This price to sales ratio is no different than what we had when you go back to 2012, right? 2013, 2010. Your price to sales is not far off, and now on that price to sales ratio, you can see that your PE is substantially lower. So if we go and take a look at the max, when you finally had a PE that you can actually talk about, and you realize now that you're, okay, it's 100, which is not great, obviously, but you can see how it's dropped precipitously, and that might be attractive to someone else. And then if you're looking at this and going, well, what else could be attractive is the year-over-year earnings growth. And you've had tremendous growth. Let's look at this over a 10-year, and you can see the growth right here. This is really going to skew you on that number. Maybe we'll take that out and just look at this on a 5-year so you can see it. So year-over-year, you're just seeing double or triple-digit growth. Even now, you're still at double-digit year-over-year revenue growth. The other thing that I would point out is that you have turned a profit for the first time. So you are starting to become profitable since the pandemic. That's a big deal. So now I have a company that is profitable. So you could see why someone might be interested in this. I have probably the lowest PE it's ever traded at, which is obviously not saying much. My price to sales ratio is right in line with where I was in 2011. Well, that's pretty interesting. The price to sales is exactly where I am now. And now I don't have anywhere near the risk that I had in 2011. So if that's the metric that you were going off of, someone that is looking at this is going to say, you know, price to sales on Tesla is actually very attractive at these levels, considering historically where it's been and the risk that we had to take on those levels before. Now they're earning a profit. And that might be something that people are going to look at. Now, if you look at the market cap and where you're at, every time you've gotten over that trillion, you've had an issue with it. But their cash continues to grow. If you take a look at their cash position over the past 5 years, they went from literally having very little cash on hand, $3 billion, 3.6 in 19, to roughly $18 billion right now in cash. So you're seeing, or cash equivalents. And so you're seeing that, and now you're just seeing revenues just completely ramp up. In 2008, we were at $3 billion. Now you're at $16-17 billion. So as we're seeing that, as we're seeing earnings rise, you're going to see people pay attention to this. I personally think it is the price to sales ratio as to why we see hedge funds so interested in being long this. Thank you again for bearing with me as we start putting this together. I do think that this will be extremely helpful for people to look under the hood at what's going on in the economy. Please comment. We're going to do these solo for a little bit, and I will have guests that will be very specific, analysts that are very specific to either SaaS or social media. It's really going to be dependent upon where the interest lies, and that's really going to be dependent upon your comments. I will be putting this on its new channel, which is Real Talk, Real Traders. That'll be on YouTube. You're probably going to want to subscribe to it. I'll link it in this description. But I'm also, for the time being, going to put this on our main channel as well. So let's just keep rocking and rolling here. So Meta platform. Okay, so if we take a look at Meta, which I'm still going to refer to Facebook, if you take a look at where you're at right now, you can see the attractiveness. you're trading at 3 times book value. Well, that's a lot to get off of this company trading at 3 times book value. So we're seeing this become a Wall Street darling. We're seeing this become a company that is going to see a tremendous amount of interest because of the assets, the value that they could possibly unlock, right? If we just look over this over a 10-year period, this is historically insanely cheap. If you just look at the average, you're looking at a 6. We're at half of that. Now, is the metaverse going to be around? Are people going to walk around as giraffes? I have absolutely no idea. Do I think that this is the time that you want to be spending that kind of money? I don't think it is. But then again, I'm not a multi-billionaire and one of the richest people in the world. So maybe he knows something that we don't all know. All we can do is look at this and assess, is this a valuation where people might step in? And the answer is, even though we keep seeing it break technically over and over again this past week, there's a buyer there. Maybe this is why there's a buyer there, because then if you look at this versus the other benchmarks that are out there, Twitter, Alphabet, Snap, Pinterest, Netflix, okay, these are all trading at 5 times book value. So this is at a substantial discount to book value, right? So if we took the average of those and said they should all trade around the same, and I would argue that Facebook should probably trade at a premium to them because they are the 800-pound gorilla. They do have their issues, but that's a substantial discount to price to book versus the other group. So you're going to see those kinds of value hedge funds. They're going to step up. They're going to take a position in something like this. Now, if you take a look at where you're at on a price to sales ratio, and we're just using the max on this, okay, you're trading at 3.5 times price to sales. I'm not really sure where they're expecting it to go. But if you look at your quarterly year-over-year growth, it's gone. But that doesn't make it less of a cash cow. Your still profit margins on all that money that's coming in, even on zero growth, is huge. Okay? Microsoft Office is still around. It's a cash cow. And that's something to think about. So you have 23% profit margins on a company that has a price to sales ratio of 3 and a 3 PE. Am I running in to buy this? No, I was actually shorted this week and did well with it. What I'm pointing out is the long-term macro view that you might want to consider in making your decisions. Now, you look at revenue quarter over quarter, it's very hard to beat. You're looking at numbers of like $28.82 billion that you're throwing off right now on a 3 times price to sales, on a 3 times book value. So why I think looking at it technically, and we can even use the market cap here, it could crack. It could absolutely crack, especially if this market picks up. I could see how this might start getting support. I could see that maybe why I might want to start looking for another possible short candidate, and I can see the long side of this. Just because you're on the other side of the trade doesn't mean that you don't want to understand what the other person's thinking. You actually really want to understand what they're thinking, because if their thesis change, it's going to be better for you. Amazon's a Wall Street darling right now, despite coming in, and you can just see what's going on here. Your price to book value is at 9. Historically, you're at 18. You know, there are metrics that you can use on these types of companies that are very clear to notice. If you're basically cut in half, there better be a good reason. Now, consumers, personal savings being down, as we went over before, they're all very good reasons, and that could weigh on them. There is a setup there short term that I'm interested in, but you would have to watch that top 10 video. I want to try to keep these separate for obvious reasons, especially if I'm going to do all audio as well. So, and please comment on that, on the audio, and how I can make it better, because there are people that will just listen to this on audio. Now, if you just kind of see where you're at here, you're just constantly dropping, right? Since this 2020, you've just been dropping on your price to book. Why are you dropping? Because you have assets and you're making a killing and your stock's going up, right? So you're making all this money. While you're making all this money, take a look at this. So you can see very clearly here, price to sales, you're at 2. Well, okay, and during the pandemic boom, we were at 5.5. Revenue quarter year-over-year growth, you're at 7%. This is historically really bad for the company. If you take a look max on this, right? You can see the huge spike when you started, and then you can just kind of see how it just straight lines. But what I would focus on is you would just take a look at the year-over-year growth in 18, 43%. You're going to see March, December during the pandemic, 45%. Right now, you do have to think about this from a different perspective, right? To compare year-over-year with pandemic levels is kind of crazy. What's not crazy is when you go here and you take a look at what happened in March and they actually lost money. That's not ideal. And that's exactly what happened. So that definitely is going to weigh on the company. I could see how people would want to stay away from this. There's some other things that are going on here that would probably be concerning to a company when you start seeing your cash and short-term investments drop precipitously. That's definitely an issue when you had 96 billion at the beginning of the year and now you're seeing and you're down to 60 billion. It's still an inordinate amount of money, but that's going to affect your book value. That's going to affect your maneuverability. Amazon is an enormous company. And if you take a look here from the earnings per share, just to put this in perspective, since you flipped and became a profitable company in December 2014, this is your first negative quarter. So this is your first negative quarter in almost a decade. So you can see why that's going to be an issue. And it wasn't even a drop in revenue that did it, right? Revenue was still going up. So I think that's very important. You had a little bit of a drop, obviously, from the Christmas season, but that's to be expected from everybody shopping on there. So you can see why some people may have an issue with this on a fundamental basis. Now, Apple's book value chart is absolutely fascinating for where it's trading at right now. You're at 41.6 with an average being 21. So I do see people like Michael Berry and why they wanted to short this. If you go through this book value, you're still at historic levels going back 3 years, 5 years, historic levels still on your price to book value. The idea that this is now the single largest short position out there, it does make sense. And I am surprised to see the reversal the other day. I actually had a long position in this. And we did in the trading room too. And then before CPI, we sold a percentage of it to cover in case CPI came out bad, which obviously it did. So protected capital. But those iPhone sales were through the roof. Are you vulnerable here? Yes, this is very vulnerable. And it's a top 10 hedge fund holding. So what you would do is maybe this is something that you might look at the other side of long term if this gets worse. I have a hard time with this, but I'm going to tell you, if you look at everything that you're seeing right now, some of these metrics, right? Because I do love the company and I'd much rather be long it, but some of these metrics are through the roof. So you're seeing, a price to sales of 6.7 right now. And then historically, if you look, your average is nowhere near that. If you look at the past decade, it's probably half of that. So you're going through this complete correction. And this is just completely not dropping the way that it should. So that is interesting, and that's definitely a data point. You have year-over-year quarterly growth, which is now down to 1%. Obviously, you have the metrics from March that you have to throw off. Your profit margins are still through the roof, where you're at 23.4%, which is great. Your cash has been dwindling for a couple years now, but you've been on an acquisition binge there. And revenue quarterly just continues to grow. Earnings continue to grow. I could see why people would have an issue with this because of price to sales and price to book. That said, you do have very large buyers out there. Warren Buffett, you have very big buyers of this company, but I could see the argument to the short side of this. So this is definitely something that you need to be aware of. If sales get weaker, Apple's more vulnerable than people think it is. And this is the type of information that you can get from looking at fundamental and macro analysis. You can understand that, hey, if those iPhone sales come in weaker, this is not going to be a small drop. This is going to be a much larger drop than people anticipate. Now, Google was very simple to look at, and you're seeing that average of 5.25. This is something I'm actually very interested in myself. This is some levels that you see it historically sit. If we look at the chart in and of itself, you'll see that it's constantly bouncing there. I believe it's bouncing off there because you're at that average price to book value. It's just a cash cow. It's not going anywhere. And you're right in line with where the other price to book value levels are on the other social media companies, and they are the behemoth. They are just a cash cow. So it's very interesting to see that price to sales is down in about half of where it was a year ago. Historically, you can see these levels. You are well below historical averages on price to sales. Your PE is down to a 19. I can't remember the last time that was besides the pandemic. Even during the pandemic, you weren't there. It looks like you were there, and maybe you were not there till about, what? Let's see, 13, 14, about 2014 you were there. So that's somewhat interesting that it's getting that cheap. Under 20 is probably the area where we're going to start seeing some support, or could see some support there with a PE like that. That's pretty low for this, just looking at this over a max period. But even taking it from 2014, I'm trading at the same price earnings multiple. My quarterly profits are higher than they have been since that 10-year period. I'm roughly at a 23% quarterly profit margin. So that is definitely something to think about. You can see that their cash is down a little bit, but not a lot. And I would just point out that they're still near, not last quarter, but they're still near record profits. They're still near record revenues, right? So if you go back and take a look at this over 10 years, they're still there. So you have record revenue, record profits that are coming out of this company, and we're trading at 20 times earnings. That's because of the market, the environment we're in, but the price sales ratio is at a historical low and the book value is in line. And I think you have to think about that. If the book value is the same as Snap, does that really make a lot of sense? Probably not, considering the issues that Snap is going through. So when you find those little disparities, they might tell you that, hey, especially comparison of fundamental macro analysis, hey, is there something there? Does Snap have a better moat than Google? And I think we all know the answer to that. It's no. When software broke this week, I thought that Microsoft was going to have some issues, but you are seeing support. And I want to just tell you what I think you're seeing. I think you're seeing people bottom feed a little bit. It's why I really wanted to go through the top 10 names that hedge funds are buying right now, because they're leaning more towards, obviously, liquidity with the names that you're going to see us run through. But they seem to be buying these at levels when you get to the average of the 5-year book value. And I don't know if that's a constant theme, or I don't know if it's a theme right now. But if I take a look at Microsoft and realize that you're still trading 11 times, that's a big number for Microsoft, right? Same thing with the book value of Apple. To me, if the S&P is going to come in, I think it's going to come in because of tech. I think the Apple Microsoft trade will probably roll over based upon looking at where you're at on book value. If you take a look at the other metrics, being at 11 on book value it's high to me it's still high, but you're at that 5-year average, so you are seeing buying, right? Now, if you look at price to sales, you're still at a 10. Historically, you were nowhere near that. You're always at a 3 or a 4. New CEO comes in, generates new cash, new revenue streams. There's a lot of business going on there, as we're all aware of. And you're well off that 14 level, and now you're at a 9. I don't know that that's going to be the issue, right? I don't know that price sales gives us anything that we can really work off of. And if you look at where you're at on revenue and growth and profit margin, I don't really get it. I don't really see it. Now, this is where you start to see it. There's a common theme that we're seeing, and we just saw it with Google. What are they buying? They're buying companies that are near record earnings, and they're buying companies that are near record revenue. So if you take a look at this, okay, you had a record revenue quarter in June 2022, in the middle of this. Record revenue quarter for Microsoft, very close to record earnings. Market cap is down precipitously from the high. So that is something that we have to take into account when we look at something like this. If I'm having record earnings, record revenues, that seems like a really safe place for people to park their money. I'm not so sure about the PE at 25. It's still historically high over the past 10 years for the company, for obvious reasons. The PE does concern me a little bit, but that is the average. It's not as much of a risk as we saw with Apple, if you remember. Here we're at an 11 on the 5-year, and here you're at, well, 1160, and now you're at roughly 11. Now on Apple, you are at a 21 5-year average, and you're at 41.6. One could actually argue that you may even be able to do a pair trade if you wanted to. In other words, let's say that you don't want to pick a directional bet, something that some people do or hedge funds will do, or I've even do them. But what you do is you would then go, okay, based upon the price book valuation, we don't know what's going to happen with the market. But if the market goes up, Microsoft should outperform Apple, and Apple should underperform. If the market rolls, Apple is way more at risk than Microsoft. So someone might even do a pair trade there where they short Apple and go long Microsoft. That does exist. I'm not suggesting that you do it, but when you see these kinds of disparities, and both of those names are 21% weightings in the XLK, which is obviously a large component of the S&P, that's something to pay attention to, because I'm not the only one looking at those kinds of disparities. Now, the interest on quad witching in NVIDIA was somewhat fascinating to me. And if you just take a look at this, again, past 5 years, the average book value is 18. You're at 13.7. There are people that are looking at these numbers and going, historically, if I buy the company here, it's going to go back to that 5-year average. Right? We revert to means. No matter how we think about it, we always revert to a mean. It's just a question of how long it takes. If you have very deep pockets and you are a multi-billion-dollar hedge fund, you're not going to care if it goes to 110. Very different from how a trader is, right? But understanding these metrics and understanding how these people think lets you know that maybe this doesn't fall off the cliff that we think it might. So if you see something like that not fall out of bed, it could be because someone is going, hey, the historic PE of this over 5 years is something very attractive. And if we're willing to wait out 3 years, we should start scaling into it right now. And they all have very similar methodologies. There's a lot of hedge funds that do some things very similar. I'm not really crazy about the price sales here. I don't really think that that's something being at 11 that is ultra attractive, especially considering what they did. They basically came out and announced and pre-announced. Just to be clear, AMD did not come out and pre-announce, and I'm just going to be very clear about this. AMD is not on this list as far as the top 10 holdings tonight from hedge fund interest this week. And I'm kind of surprised by that because it makes more sense to me, right? Because they're the ones that are coming out and keep confirming guidance and earnings and talking about how things are ramping up. We saw that comment out of Taiwan Semi and how they're talking about how they're ramping up. But what we're not seeing is anybody really believe it. They're trading AMD and they're trading NVIDIA in tandem. You know, why we have this up, I think that might actually be interesting to look at, why we're here. Yep, so I mean, AMD is trading at half the price sales multiple, 4.8%, versus what we're seeing from something like NVIDIA. And meanwhile, AMD is coming out meeting, exceeding expectations. Cash seems to be going up. Looks like we have record revenue going on right now. So that's a very interesting disparity. Now, this is fascinating. I'm glad we did this. So AMD's price to book value, for those listening on audio, is currently 2.23 with a historical 5-year average of 18.7. So the probability of this staying down at this level on any kind of rally is extremely low, and candidly makes this a more attractive vehicle to be in than something like NVIDIA. NVIDIA may move more in the short term because of the short interest in it, and obviously the cutting edge chips, they're different chip companies, and 5 to 7 nanometers. We're not going to get into all that today, but they're different companies, and yes, there's different growth rates, yes. But from a valuation standpoint, from a safety standpoint, you would have to look at AMD and this 2.23 book value and say that's very attractive. Again, you might even see somebody go out there and do some kind of pair trade where they go short something like NVIDIA for a long period of time and go long AMD because they believe in the sector. I have a really hard time thinking that this is going to stay down on this level very long. I almost want to find out what happened here and what transpired to knock it down to that level. Maybe it was just, we obviously came in on the stock chart, but that's a really big disparity. And if we go through that here, we can just see this line by line. And we've been here for a while, so it's not like it just happened overnight. You can see that it's been here since about April. So something to think about, and definitely something that will be on my watch list. I'm going to want to watch that a little bit closer. Now, Amgen is getting a lot of interest from hedge funds, and I'm not really sure why. You're at 2.5 times your average book value. It seems very exposed to me. Obviously, you had this huge spike in the stock during 2022, but what you're seeing here, you're just kind of leveling off, and you're still above averages. So if we went here and take a look at the multi-charts, maybe we can dig into the data and figure out why. Now, you're not seeing price to sales as anything great, so I don't really see the rush there. You're at 5%. Quarterly revenues at 0. Profit margins are actually dropping down, but still high. You're at 20%. But I just don't see the big interest. Now, there seems to be interest in these names, and I'm going to point this out. We're under 20 on the PE again. That might be it. There were a couple other names that really got interest this week that were under that PE. You can see the market cap and how it just dropped recently. And there seems to be another really common theme that we're seeing out there, and I should point it out. You are near record revenue again. You're near record quarterly revenue. And that is the theme that we are seeing with some of these names. That may be the draw of something like this. It's not something that I would run out because of that, but maybe that is where the interest is coming from. And maybe it's something for us to monitor. I personally think there's much better biotech names out there, but this really seems to be getting all the interest right now. Interest in Oxy actually picked up. Occidental Petroleum actually started picking up this week, which is somewhat fascinating considering what we saw oil do. Again, please comment on these videos, specifically this one, because we're going through a lot of details. This is obviously going to be longer form content. This is not going to be edited. We're just going to upload it, go from there, and then you're going to comment, and we're going to make it better and more valuable. But your comments will help on how I'm going through this. I think understanding what we're doing is going to be very good, especially for newer traders, so they can understand how these larger people, these larger funds actually think. So historical average has been 2.38, but we know they're ramping up production. So price to book value is probably something that's going to be a really tough metric for it, but you're roughly at 3. It's not crazy. It's not the max on where it was back in March. But if you look at the other fundamental analysis here and you look at price to sales, right now you're at, in 2020 you were less than 1. So you're really at 2 times price to sales, which historically is extremely low for this company. The PE is going to be spotty because it never really had NE. Profit margins are finally starting to rise after their large merger, and you actually saw them spike to 58.4%. Now they're at 35%. Revenue quarterly year-over-year growth, that is just astounding. You are currently at roughly 80% quarterly year-over-year growth. That's huge, and that's probably the draw of somebody like a Warren Buffett, despite the industry that it's in. You're watching cash and short-term investments come down, but here is the current theme, and this is the theme that we're seeing from all these investments. We are at record revenue. Are we at record earnings? I believe we are. So we are at record earnings and record revenue. So we are seeing a common theme. So if we were to take the data of the top 10 most active stocks for hedge funds and institutions this week, the one theme that we're seeing so far is not so much industry, because we're all over the place with industry, but we're seeing the theme with record revenue, record earnings. And we just saw that in about 4 of the names. So I do find that interesting, and that may be something that you want to do a screen for your own longer term investments. Berkshire Hathaway, a lot of interest this week. Basically, to me, you're buying the the index, but obviously there's a difference based upon their holdings. Now, you're basically always trading near book value. They usually give a premium because of Warren. Right now, you are at 1.35 on a 5-year average. You're currently at 1.32. So you're right in line there. What could the interest be? Maybe exposure to Oxy, maybe exposure to Apple, since they participate in both those names. But you're really falling off a cliff here in a couple of things. Your price to sales is actually peaking up a little bit here. So your price to sales for this is at a 5-year high. That's not really what you want to see. Let's take a look at that 10-year high, not on these kinds of names. So you're still at historic levels on price to sales for a company like this, which means that maybe Apple and Oxy are going to get a little more buying pressure from him, because if he adds to those stakes, he's going to lower his price to sales on his other companies, right? So if you think like that, you start connecting the dots, it starts to make a little sense. We're seeing year-over-year revenue growth absolutely plummet down to 90% this last reading, and now they're saying that quarterly profit missed, which is, I'd really like a better understanding of that, because he never really misses. So there must be something there that we're just not picking up by looking at this data. And you're seeing revenue and earnings just absolutely plummet here. So maybe there's something going on in the way that they're accounting for their revenue stream. So that's definitely something that I want to look into a little bit more. I don't really see the interest in this. It doesn't really do anything for me. The only thing that I would take away from this is that the price to sales ratio is high. Therefore, maybe they're going to want to add to companies that are going to drop that ratio. And that would be companies that are at record earnings and record revenue. And we did go through a couple of those today. So I hope you found this helpful. I covered the gambit. We went through a lot. And again, please comment. I will load this into the new channel, which will be called Real Talk, Real Traders on YouTube. And I will also be putting this on Arete Trading for now, so people can get exposure to it. This is just going to be posted raw and unedited, so please go through it, tear it apart, comment on it, tell me what you like, tell me what you found completely boring, and I would appreciate it. Please subscribe to the channel and also subscribe to Arete Trading. And I really think doing this once a week and going through this data and how this data is affecting the underlying securities give people a better understanding of what they need to look for during the trading week. It's very helpful if you can start looking at where the inflows and outflows are, what the economic data actually means for the particular sectors, and what the larger funds are actually looking for. Now, I also do plan on having guests on. I think it'd be good to have analysts in very specific fields. Some traders as well, obviously, but I really want to focus on the education so that people can understand why they might want to buy something like Snow versus CrowdStrike. And they're the kinds of questions we really need experts for, and we would have questions for, obviously. So that's it, everybody. Thank you for listening. If you're on audio, please comment as well, because I need to know how I can make this better for audio as well. Have a great day, everyone.